I'm going to tell you about an invention that has survived every empire, every war, every economic collapse, and every technological revolution for nearly 5,000 years. You probably used it today. You trust it with your salary. You panic when it stops working. But here's the strange part. The first bank wasn't built for money. It wasn't created by businessmen. And it definitely wasn't invented by bankers. It started because a temple priest looked at a warehouse full of grain and asked one simple question. Where are we going to store all of this? That tiny decision accidentally created a system that would finance empires, build fortunes, crash economies, and leave billions of people paying interest thousands of years later. And the most unbelievable part, your bank still works on almost exactly the same idea. To understand how, we have to travel back nearly 5,000 years to the ancient city of Uruk, located in southern Mesopotamia between the Tigris and Euphrates rivers. Uruk was one of the world's first great cities. Its people had mastered agriculture, not just enough to survive, but enough to produce something civilization had never really seen before: surplus. They harvested more grain than a single family could eat, protect, or even store. And suddenly, having too much food became a problem. Where do you keep it? Who protects it from thieves? Who remembers exactly how much belongs to each family? The answer wasn't the government. There wasn't one. It wasn't the military. It wasn't a wealthy merchant. It was the temple. Back then, temples were much more than places of worship. They were the most trusted institutions in the city. They owned large storage buildings. They employed scribes who could read and write. And because they represented religious authority, people believed their property would be safe there. So every harvest season, farmers brought their grain to the temple. The priests carefully measured every sack. Then they recorded the amount on a small clay tablet. That tablet was incredibly simple. It basically said, you deposited this much grain on this date, and you can collect it later. That's it, the world's first deposit receipt. 5,000 years later, your banking app tells you almost the exact same thing. Different technology, same promise. But here's where history takes an unexpected turn. Months passed, and something strange happened. Most people didn't come back for their grain. At least, not at the same time. Some waited until winter, others until the next planting season. Some left it there for years, and some never returned at all. Imagine walking through warehouse after warehouse, filled with grain that wasn't moving. To most people, that's storage. To one clever administrator, it looked like opportunity. Now imagine another farmer. His crops failed. Without seed grain, he couldn't plant next season. Without planting, there would be no harvest. Without a harvest, his family wouldn't survive. So he went to the temple, not to pray, but to borrow grain. The priests looked at their warehouses. They knew something the farmer didn't. Most of the stored grain wouldn't be collected for months. So they made a decision that would quietly change history. Instead of letting the grain sit there, they lent it out. The farmer received the grain today by Monday and promised to return it after harvest. But not the same amount. A little more. Without realizing it, the temple had created something revolutionary. It wasn't just storing wealth anymore. It was putting wealth to work. And that single idea became the foundation of banking. But lending money or grain is easy. Getting it back is much harder. And that's where the story becomes much darker. Because the invention that helped build civilizations would also trap millions of people in debt. And that's exactly what happened next. The Sumerians had a fascinating word for interest. They called it mash. Oddly enough, The same word also meant calf. To them, a loan worked like livestock. The grain you lent out was the cow, the extra grain you received back was the calf it produced. It was a simple idea. Your wealth could create more wealth without farming another field, without planting another seed. For lenders, it was brilliant. For borrowers, it could become a nightmare. Because nature doesn't care about loan agreements. Sometimes the harvest was excellent. Sometimes drought destroyed everything. Sometimes floods wiped out entire fields. But the loan didn't disappear. The farmer still owed the grain, plus the extra. Whether the harvest succeeded or failed. And if he couldn't repay, the temple collected payment another way. First came livestock, then farming tools, sometimes land, and in some documented cases, even labor. Debt slavery existed in ancient Mesopotamia, not because the system was broken, but because the system demanded repayment. That's an uncomfortable thought. The same institution trusted to protect your wealth also had the legal right to claim your property if things went wrong. Thousands of years later, that relationship still exists. Today, banks don't take your farm because of a failed harvest, but if you stop paying your mortgage, they can still take your house. The tools have changed, the contracts have changed, the principle hasn't. And yet, despite its risks, the system worked incredibly well. So well that it spread across the ancient world. The Babylonians didn't invent banking, they improved it. Private merchant families began accepting deposits, making loans, financing trade, and keeping detailed financial records. One family became especially famous, the House of Ajibi. Archaeologists discovered thousands of their clay tablets. Reading them feels surprisingly modern. Customer names, loan amounts, repayment dates, interest rates, business partnerships, property sales. It's less like reading ancient history and more like opening a filing cabinet at a modern bank. As trade expanded, banking evolved. Merchants faced a new problem. Traveling across countries, carrying bags full of silver, made them an easy target for thieves. So banks began selling something even more valuable than money: trust. Instead of carrying coins, you carried a written promise, a document proving your wealth could be collected somewhere else. That simple idea made long-distance trade dramatically safer. The Greeks embraced this system. Money changers sat behind wooden benches in busy marketplaces. They exchanged currencies, they accepted deposits, they made loans, and financed merchants. Centuries later, Italian bankers would use the word banca, meaning bench. That's where the modern word bank comes from. Then came Rome, an empire stretching across thousands of miles. Moving large amounts of money by wagon wasn't just inconvenient, it was dangerous. Roman bankers developed sophisticated financial tools, including early forms of credit and written payment orders that allowed merchants to access funds in distant cities without transporting large amounts of coin. For the first time, trust traveled farther than money itself. But something else traveled with banking: debate. Should people be allowed to profit simply by lending money? Religious leaders argued about it. Philosophers argued about it. Kings argued about it. And lawmakers argued about it. As early as 1754 BCE, the Code of Hammurabi didn't ban interest, it limited it. Because even then, people understood something powerful. If interest grows without limits, wealth doesn't just grow, it concentrates. 5,000 years later, we're still having the same conversation. And that's the remarkable part. Empires rose and fell, currencies disappeared, kings became presidents, clay tablets became smartphones. But underneath all those changes, the basic idea never really changed. People deposit wealth. An institution lends it to someone else. The borrower pays it back with extra. The institution earns a profit. 5,000 years of innovation, and the foundation is still the same.